What is going on? Welcome back to my channel. I'm the covered call guy, and on my YouTube journey, my goal here is to create $120,000 in annual passive income. Right now, just using covered call ETFs until I reach my goal could change. My projected annual dividend slash options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 daily, and about $9.42 hourly. Legal disclaimer before I start this video: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. With that out the way, let's get started. All right, so this video was requested from a comment below for a kind of a strategic analysis between SLVO and AMDW. Not comparing the two, just two separate. I just verses there. I could have just put like two separate, but it was requested by Tasman Somerville. So we're just going to do a deep dive on these two different income derivatives. The goal here is breaking down the return engine durability, bear market stress, and structural integrity of the two, not comparing each separately. All right, so let's look at the financial engineering of the yield, right? Beyond the headline of these two, right? I'm going to be evaluating SLVO and AMDW, right? Through the lenses that supersede headline yields, because we don't want to just look at the yield. I always stress this in all of my videos, right? Do not just look at the yield. Do not just buy something because of the yield, right? While both market themselves are income generators, they are fundamentally volatility harvesting instruments with distinct failure modes. Okay, there's two ways to die here. SLVO, it utilizes a legacy debt structure, ETNs that could fail slowly via NAV erosion, right? It's very silver market dependent here, right? And AMDW utilize a modern leverage equity structure, ETF, that risks rapid capital consumption. Okay, the two reality here is that yield is not the product, structure is the product, and I stress this a lot. You guys have to look at how the structure is built, because if the structure is it can hold, it can last. Otherwise, you're looking at it more from a tactical trader point of view. All right, let's look at silver, right? SLVO, it is a credit-linked volatility note that monetizes silver's high implied volatility, but suffers from negative convexity. AMDW is going to be in a teal color, right, from AMD. All right, so I'm going to separate the two by colors. It is a leverage trading vehicle that manufactures yield through capital liquidation, right? Return of capital, structurally designed for short-term momentum. So as long as you understand that part, the verdict here is both rank significantly below competitors like NEOS or JEPI in structural stability. All right, let's talk about silver. Right, structural chassis and legal frameworks. Right, the warning here I would say is to evaluate risk. I must first deconstruct the legals vehicles here. For SLVO, the ETN debt trap. I own debt, not silver. That's what you're doing when you're buying this, right? SLVO is an unsecured senior debt of UBS Group AG. It is not a fund. It contains no silver and no options. When you're doing this, when you're buying this, you are becoming a general creditor. The binary risk is that while the obligation transferred to UBS in 2023, the risk remains latent, right? If UBS credit spreads widen, then my ETNs could trade at a discount. And then could lead to this other problem, which is called the broken peg. ETN issuers can suspend new note creation. If this happens, price dislocates from value, creating a premium that inevitably collapse on me, right? That's the broken peg. It's not pegged one for one anymore, right? So the risk here is that I'm loaning money to a bank to trade silver volatility. Remember, you're not actually buying any silver. Right, AMDW, right, the single stock ETF. Let's talk about the 1940 Act of ETF, right? So the asset are segregated in a trust, eliminating issuer credit risk. Synthetic exposure, because AMDW achieved its 1.2x target primarily through total return swaps, TRS for short. You see that in other, pretty much in other type of wording if they put out from their social media, TRS, right, with prime brokers and financial drag. The fund pays a financing rate, typically SOFR plus spread, right? In a high rate environment, this creates a hidden drag on NAV, approximately 5 to 6% annually. You are not, I don't think a lot of people actually kind of factor this in. They just look at the yield and look at the look at the payout and say, okay, this is the underlying, and then don't actually look at how it's being operated underneath the hood here, right? You have to look at the actual cost. I am paying hidden financing costs to maintain leverage. Remember, I talk about leverage a lot. If you have to ask about leverage or margin, and that means you don't know enough, right then and there you should probably start backing out, because if you have to ask about these type of things, that is not for you yet. You're still too new. You still have a lot more learning or more experience to kind of gather, and then you can go and kind of dip your toes into this. All right, return engine and stress testing, right? The engine, what actually pays me and why does it bleed? All right, let's start with SLVO, the negative convexity trap, right? I talk about this a lot in all of my videos. Let's look at the engine. It tracks the credit suite of NASDAQ Silver Flows 106 index, holds notional long SOV, that's the underlying, and sells monthly calls options at 106% of the spot price. Why does it bleed? Because its upside is capped at plus 6% per month. If silver rallies plus 20%, I only capture that 6%. The downside is uncapped. If silver drops 20%, I drop 20% minus premiums, right? The math here is that I take all the risk but cap my reward. The March of 2020 was the massacre, right? During the COVID liquidity crisis, silver spot collapsed. So SLVO suffered a drawdown of 70 to 80%, give or take, around there. Because the recovery was reshaped, SLVO was capped out of the rebound and permanently impairing capital, right? This necessitates periodic reverse splits, right? The one for 20 split in September 2022 to maintain the share price. And if you know anything about this, if you're new, right, I do talk about this as one of the red flags, right? If you see a lot of issuers, these certain issuers doing reverse splits to maintain the survivability, then it won't survive, right? You gotta look back at the history. Once the capital is gone, it can't be earned back. All right, let's look at AMDW, right? The leverage decay, right? The methodology behind that is it targets a 1.2x, right? 120% of AMD's return. Resets weekly. So unlike UMAX, AMDW generally does not sell calls, right? It has intra-week drift. Because leverage is reset weekly, not daily, the fund is subject to path dependency. If AMD drops Monday to Wednesday, effective leverage increases, right? The trap here is the subsequent rebound Thursday to Friday must overcome the deeper hole. This can lead to the drag I'm talking about, right? Volatility drag the NAV down even if the stock stays flat. Remember, leverage only does well in a semi-upwards bull or in a bull market. WPay is an example. I always warn those who own WPay is that leverage, right, only performs well in an upwards bull or in a straight bull market. Right, AMDW, the wipeout barrier. So these are just my scenario. This is a scenario, right? So in a non-linear tail risk, right, I'm using 20% leverage. To hit zero, the stock doesn't need to go to zero. It only needs to drop enough to wipe out my equity cushion. Okay, that magic number for AMDW is 83%. While it's still kind of improbable, this is a theoretical limit. Okay, this might not happen unless we get a crazy COVID crash again, plus another tariff crash on top. That may not happen, but what could happen is the slow death. A 20% drop in AMD resulted in a 24% drop for me due to leverage. If it recovers slowly, the weekly reset plus financing costs plus distribution act as gravity. I bleed out without a crash. The proof, I found proof. In 2022, AMD lost just about 60%. The underlying lost about 60% of its value, right? So a 1.2x leverage strategy would have been crushed, absolutely destroyed if you had AMDW, if it came out during that time, right? The risk is death by 1,000 cuts, not one giant blow, because you don't need one giant blow to wipe you out. A lot of people don't actually know about this or don't think about this when it comes to leverage. You don't need the stock to drop to zero. You need the stock to drop, 50-60%, and you're gone. It's done. All right, sustainability and breakpoints for silver, right? The question is this real income, or is it just my own money just returning it back to me literally? All right, SLVO breakpoints, the yield source, option premiums, which is ordinary income. Sustainability, sustainable only in sideways or slightly bullish markets. The breakpoints, I'm going to say, occurs when silver's price decline is greater than the premium collected, right? The payout acts as a buffer, but not a shield. All right, so the breakpoint here is when the price drops, beats the premium, I eventually lose money. All right, AMDW, the melting ice cube, right? This is the hurdle rate. AMDW pays a managed distribution derived largely, of course, from ROC, return of capital. If we're assuming a 40% target yield, 5% financing, and 1% fees, AMD stock must rise 38% annually just for AMDW's NAV to remain flat. The implication of this, if AMD is flat, 0% return, AMDW's NAV will erode by 46% annually. This is simple math. I need a massive bull run just to break even. Okay, simple math here. Because right now AMD is doing relatively well, right? Year to date, I think it's, last time I checked, was like up 6%, 5 to 7%. It was up like year to date, up 7% or something. So it's doing relatively well. Okay, we're about 2 months into the year, right? And you're up, let's just split it, 3% last month, 3% this month, right? So you still have some time. But this is a scenario you have to think about. So it's not all sunshine, right? I talk about it, the melting ice cube. I use this reference a lot in all of my other videos, especially when we're talking about leverage. All right, structural integrity ranking. This is kind of my is not something that's it's true facts. This is just something I put out as kind of the way I see it. So again, take this with a grain of salt, okay? Little drizzle here. All right, tier 1, I'm gonna always, if you're gonna be putting up against neos, I'm gonna say it's a tier 1, right? Bear market survival is strong. Tax loss harvesting. Tier 2, I would say go ahead and put JEPI and JEPQ up there, right? Bear market survival, I'm gonna say strong, very conservative beta. And then tier 3, I would put that above these two, right? I'm gonna say even yield max. And the bear market is weak, capped upside limits recovery. And then tier 4 would be the silver, right? Bear market survival, I'm gonna say fragile, very fragile, right? Credit risk plus negative convexity. And then below that is tier 5, right? AMDW, right? Is a leverage ETF. In the bear market, I would say you get absolutely destroyed, right? Very consumptive, decay plus rock erosion, right? This is the hierarchy. SLVO and AMDW are at the bottom of the safety barrel. In my opinion, I could be wrong. Again, we're talking about a bear market survival here. All right, market regime matrix. Okay, this is kind of my scenario, my take on it again. All right, so in the bull market, I would say SLVO behavior, all right, it underperforms because it's capped upside at 6%. I mentioned this, right? And AMDW behavior outperforms. Again, bull market, it would absolutely destroy, right? 1.2x gains. Sideways, SLVO, I would say outperform here because you're collecting the premium harvesting. And AMDW, I would say sideways markets, decay, right? Is leverage, reset drags plus payout. In a bear market, SLVO, right, capital impairment drops 1 for 1. I mentioned this earlier. I think that will happen. AMDW, right, rapid erosion, 1.2x losses here. Volatility, Well, if it's very choppy, it's very up down, it's very up and then down down. Right, I would say it's SLVO is very mixed here. The yield spikes, but the NAV can drop. For AMDW here is neutral to, I would say, leaning towards negative. Right, drag hurts leverage. The context here is there's no all-weather winner here. They kind of need one market to perform well for the certainty. Right, SLVO, the tax burden. Right. This one is called the half-life, the long tail decay, because it bleeds value slowly relative to inflation. All right, the tax status, I think it's ordinary income, which is inefficient. I could be wrong on this. Let me know. All right, subject to prepaid forward regulatory risk here, and AMDW is the tax alpha in terms of these two. Half-life, short half-life. All right, NAV can have in less than 2 years in flat market. Right, the tax status is return of capital, tax deferred until sale, useful for high market traders. Okay, I would say traders. If you're a short-term trader, this is for you. All right, the strategy is that AMDW has a tax advantage, while SLVO, I think right here compared to these two, is the tax burden. Right, so who should never own this? I'm gonna say, of course, retirement accounts. Right, SLVO tax inefficiency is wasted here. Just own the actual underlying or own physical silver here. Right, and AMDW's erosion risk is too high for retirement account. You're absolutely nuts if you put in a retirement account. Right, and income dependent investors. Right, neither offers reliable income. SLVO's coupon fluctuates and AMDW's payout is liquidation. Okay, unless we're in a true bull market here. Buy and hold investors. Right, both require active tactical management. As I mentioned before, this is for tactical traders. If you're in and out short term, then this will be for you. Right, my warning here is these are not set and forget investments. Do not play them as set and forget. Right, but who should own this? Right, SLVO, the silver bull. If you believe silver will trade sideways or slightly up for the next 6 months, right, SLVO will vastly outperform spot silver due to the massive premium harvest. If you are a believer in AMDW, right, you are the tax trader. If you're in a high tax bracket and want to trade short term, AMD momentum while deferring taxes via ROC, AMDW is a powerful tactical tool. So the use case for these two is that they are tactical scalps, right, not long-term holds. I want to emphasize this a lot. Right, my final verdict here is that if distribution requires the NAV to die, it's not income, right? It's liquidation. The proof is that SLVO in a V-shaped recovery, the 106% cap prevents NAV from regaining highs, right? While downside is fully realized, right? The math here is that it's decay, and the proof for AMDW is AMD is flat. The 40% payout comes from 100% of principal, right? Because it is also a 1.2 x leverage. It drags and choppy markets, which accelerates this, right? Math equals liquidation. The truth here is this is not a safe yield trade. So understand when you're getting into something like this, it's not safe. Understand you get in, you get out, you know how to read the market, you kind of predicting, you're guessing in the next 1 to 3 months, 3 to 6 months that this will play out in your favor. Get in, get out. That's it. That's how I would play these. All right, thanks for watching, guys. All right, I always say don't mistake a melting ice cube for a dividend machine. I also appreciate you guys leaving me a comment on what video should be next. So, leave a comment for the next video topic. I always appreciate you guys. Thanks for watching. Stay tuned. Catch you guys at the next.